time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. I'm going to start with the Your Stock, Our Take listener question or viewer question on Hamilton Thorne Limited, symbol HTL on the TSX Venture. Trades around $1.63, $237 million market cap. The company sells lab equipment, consumables, software, and services primarily to the global assisted reproductive technology industry, which captures in vitro fertilization. Hamilton Thorne sells the portfolio branded and third-party offerings on a global basis through direct sales and distributors. So let's start by looking at the balance sheet here. The company has around $15.85 million in cash as at its last period, $16.97 in debt. So net debt is just over $1 million. So pretty solid balance sheet, relatively speaking. They just released their first quarter 2023 results. Sales increased 19% to $16.7 million. And first quarter adjusted EBITDA was up 13% to $2.8 million. Now, organic sales were up 15%, which is great to see. The organic growth, was up 15%. And net income, however, decreased to just $77,000 for the quarter. Cash used in operations in the quarter was about 142 in that range, thousand. So the company has been historically cash flow positive, and this should be the case over the remainder of 2023. But even taking last year's operating cash flow, which was $1.8 million, the company would then trade at around 132 times cash flow. Now, 2022 cash flow was depressed. So if we go back to 2021, on an operating cash flow basis, if we see what it's trading at today, it's about 42 times. Historically, the company trades at about 20 to 30 times cash flow. Now, generally here, we look at the share structure of the company. Historically, it has grown via acquisition and has issued shares and used debt to pay for that growth. There is organic growth, like we said in the last quarter, but a big part of the growth has come from acquisitions. This has taken the share count from about 52 million shares in 2014 to 144.8 million shares today. That's almost 3 times higher. Now, Hamilton Thorne is not nearly the worst offender in respect to increasing its share count. It has grown on a per share basis, its cash flow historically, but we do find that most small and mid-cap companies that are tremendous performers over the long term, they find a way to provide less dilution as they grow over time. Included in this list of companies that we've recommended in the past that have been tremendously successful and not increased their share count significantly over 5 and 10-year periods would be a company like Expel, Hammond Power, the Boyd Group, and Water Furnace. Names from our coverage that have done 10 times performance, had tremendous growth and limited share dilution over the long term. So that's a general thing that we would like to look for in a business, limiting the dilution that the company provides over the long term. So our take overall on Hamilton Thorne, I see the business as run by competent management in a solid industry that is currently producing strong organic growth, and they're taking market share. The company has a reasonable balance sheet and growth in revenues at a solid pace from $7.9 million in 2013 to about $78.8 million in 2022. Over that time, the stock has performed well, going from 10 cents to $1.63 today. Operating EPS has been a bit more volatile over that period. If you look in 2023, operating income was roughly $400,000. It surged to $5 million in 2018 and 2019, just over, but has failed to return to that level since. 2020 was affected by COVID, but they moved closer to that figure at about $4.8 million in 2021. But in 2022, they declined on an operating income basis to $3.3 million. As we stated to start 2023, cash flow was negative. Operations should continue to normalize and contribute to the negative cash flow turning positive over the course of this year. But there was some one-time items, including timing of increased accounts receivable, reducing accounts payable at the end of the quarter, that did contribute to the 2023 Q1 negative cash flow. Inventories were up slightly as the company begins to unwind significant investments in inventory that were made in 2023. Again, on a positive note, organic growth, which eliminates the effects of both acquisitions and exchange rates, was up 15% for this first quarter, reflecting, again, like we said, continued market share gains. Management has stated they are actively working on multiple acquisition opportunities as well, and they do have the cash on hand to do that and a debt facility that they can tap into. Hamilton Thorne is interesting. It's a good niche player, but the stock currently trades at roughly 90 times EPS and well above historical cash flow multiples. Good business, but expensive until it generates better cash flow.
Right. And what we would want to see from a company like this, which is a small cap, is, we would want to see it trading at a discount to large cap comparables. And this is not at all the case. So, at a valuation, I mean, if you look at analyst expectations for the current year, analysts are looking at about 4 cents in earnings. So that brings them to, I think, about 45 times roughly.
Yeah.
That's still that's a major premium valuation. I mean, there's a lot.
And that could be on adjusted earnings too. It looks like that would be adjusted
earnings as well, right? So, premium valuation, a lot of expectation baked in, not a lot of flexibility to disappoint.
It's a good business in a unique niche, and it may be one of those that could be a takeover target over the long term, but we're not going to buy it just on speculating on a takeover. They certainly, they've grown revenues at a high rate. They've grown the share count significantly, like we said, too. So you really have to, you grow those revenues to produce per share cash flow that increases over time. They're going to have to really ratchet up margins and produce better cash flow. That would get us more interested. Good top line growth, a little more spotty cash flow growth, and we'd like to see that follow the top line growth at a better clip and more consistently over time. Again, we have talked with management in the past. I think they are well run. I think they've done a reasonable job at growing the business. The share price has done reasonably quite well over that period of time where they've been executing acquisitions and now growing organically as well. But it is expensive on a cash flow basis. We want to see, like Aaron said, likely a discount to some larger players, not necessarily in the industry or the market overall, and then buying a good business, reasonable price. And right now, good business, we'd like the price to be better to be buyers of this company.